can get into small and mid-cap stocks and why and how are they getting smoked, and that's what I intend to do with Vinit Sambre. He specializes in the small and the mid-cap stocks. He's been, however, making a case, I think, starting last October, that even though he's a mid and small cap specialist, that space was overdue for a correction. So Vinit, it was a good call in October. Fund managers normally don't come on our show and say the space which I manage, which is small and mid cap stocks, are overpriced. Has that froth been churned out? Are you finding now the word value coming back in small and mid cap stocks?
Hi, Nikunj and team. Good morning, and thank you for having me on the show. So, first of all, thanks for that acknowledgement. And I would say that, anyways, since last year when things were very frothy, we were a bit cautious on the valuations. I mean, businesses generally tends to attract us given their long-term outlook. So I think we keep looking at that. But the good part now, Nikunj, as you asked me about whether the froth has got cleaned up. I would say in some pockets we are getting that opportunity. We are finding time to do research on companies and businesses, take time, deep dive, and then take a decent call. Otherwise, it was a scenario where you think of a name and it just flies off. So there are some pockets even right now where retail participation seems high, and there are stocks which doesn't warrant to trade at levels what we see every day. But nonetheless, I think some fear has set in, which is good from a long term investment perspective. We are looking at few opportunities across some sectors. You were talking about auto. We believe that auto cycle should turn around over the next 2 years. So you need to take a slightly 2 to 3 years time horizon, keeping that into mind. We believe the agri sector sort of is showing some promise in terms of what we are now getting to hear from incrementally, not till December, but incrementally the rural economics seems to be showing some signs of improvement. And beyond that, I would say the banking sector, anyways, is something which we have continued to, have a positive view on. So, some of these segments, where we are finding valuation becoming reasonable. We are definitely putting in efforts to, explore these more and look for opportunities within those categories.
Uh, Apart from words like moderate returns and high volatility, how do you think this year will be different from last year in terms of themes and outperformance and underperformance?
Yeah, so I think the most important aspect, which I believe for returns, eventually, I mean, the macro factors are always there. You will have headlines, you will have noises, but most important, what keeps driving the returns for equities is the growth. And any challenge, if one sees on the growth front, is something which brings some amount of nervousness or mediocrity in terms of the returns from the equity perspective. So if one thinks about the growth, in the quarter went by, there are some signs of moderation given the inflationary pressure. The price points across the board have risen. Uh, Consumer sentiments has been a bit low, which is already getting signaled from the result. Now the fear is that 1 or 2 quarter more of this dismal performance can basically bring in some bit of downgrades in terms of the growth expectation what generally people are building in. So my worry in the near term would be to monitor the growth, and if the growth doesn't improve immediately, I think that will have some impact and bearing on the market's overall performance. But at the same time, I'm hoping that whatever announcements the government has done in terms of pushing the growth back through the capex momentum, that should start, and that should pull up some bit of that sentiment and growth factor in the second half. So I would say we may go through some bit of a seesaw where we have the first half being slightly more struggling, and second half is where we see some bit of that return coming back. So I think net through the year, my expectation is that we may still be above the water in terms of the return expectation, but we might have seen a dip and then a comeback is and this is purely going by the fundamental cycle of the corporates is what I'm thinking about.
What is the right way to understand the entire tech space, and I'm keeping IT services aside. I'm including, let's say, the internet companies and even some of the niche companies like MapMy India, RateGain, the pure platform plays. Uh, Markets first got euphoric. Now they are disregarding them like a stepchild. Do you think the internet stocks or the new tech stocks will settle somewhere in between? I mean, earlier it was a feeling of carnival, now it's a feeling of mortuary.
So I think even within the stocks, there need to be a bifurcation between where there is a hype in terms of valuations, maybe given, let's say, the low profits or future profit or based on future profit whenever companies are getting valued. I think those definitely will see difficult times, is my sense. Given that we are talking about higher interest rates in the economy, and whenever we do these small bit of changes in our DCF valuations, we come to the understanding that all the future profits, when discounted at a higher rate, brings down the valuations significantly. So I think that is something which will see the bearing. And the now the second part is where the businesses are okay, but valuations have gone astronomical because of the some bit of the frenzy or some bit of the theme element catching attention of the investors. I think to some extent, once the frothy element of the valuations are off from these, I would say they should settle, because they have strong fundamental businesses to justify at certain level valuations should sustain. So I would say that I would like to bifurcate between the businesses where it's more based on future profits. Those need to be sort of discounted. And the ones where there is promise of cash flows, there is promise of future profit, we need to wait for a right price point. We need to have a reasonable valuation matrix in mind for them to start evaluating.
Good morning. So, as Nikunj was also saying in his introduction, you're one of the first few to also flag off, right, the rotation and the reallocation from the small mid caps towards the large caps. Now you're talking like this as far as profit pools go. Is there going to be a change in leadership that you will see in 2022? Is it going to be more for the value stocks and that continuing rotation towards the large caps?
So, there is one more, I would say, bigger event which, from the top-down perspective, one has to think between the large cap and mid caps and the small caps. If you go back in history and look at the 2013 taper, when it took place, it was the small caps which, as a category, which got impacted slightly higher. And just trying to draw from that time, if I'm thinking of the outlook going forward, phasing out, outlook coming in the same manner, then I would say there is some bit of that uncertainty or cautiousness which the small cap as a category should face, and which actually makes me feel that at least for this year, one should have a good balance of diversified funds, where you have a good combination of mid cap and large caps as well, to hold the fort. And that is what I would sort of continue my stance, at least in the first half. And for investors who are, having a slightly more risk appetite, and a longer duration, I think for them the volatility certainly becomes a friend, and they should sort of think of increasing their allocation to this category as well, but with a very long term view, because the long term picture is very clear in my mind. It is the small caps and the mid caps which tend to create an outperformance over the large cap, and the very simple reason for that is the growth in these companies that outpaces the large caps in a way. So as the higher growth keeps compounding over a long period of time, the small caps and mid caps tend to outperform the large caps. So that thought stays as far as I'm concerned.
Okay, so stay invested, compound, let the rule of 72 kick in. That's as far as the small and mid caps go. But taking forward the rotation that you're expecting in the first half, the large caps that you're talking about, the certainty from the Fed rate hike to everything else that's taking place, you touched on a few sectors. I want to rephrase it and say, Vinit, what would you stay far away from, or like what would you sell?
So I think clearly wherever the pricing power is poor with the companies, I mean those companies one should sort of stay away from as of now. Wherever we don't see good profit cash flow conversion, the profit converting into cash flows, I think one should avoid those companies. Highly levered companies is something which we should avoid across the categories. One can think of these buckets. And I would say that what one should really focus on is companies where, given the inflationary environment, it is going to be very difficult for companies to keep passing on the price hikes. And wherever the businesses are slightly more inelastic in nature, wherever the price hikes are slightly more easier to be passed on, I think those businesses should be looked at. And clearly, the negatives would be the ones where we don't see those taking place.
Vinith, you spoke about your view on banks a short while back. Just wanted to understand, because as I see it in the larger pool of the DSP MF portfolio, SBI has been added weight and ICICI Bank has been reduced. Correct me if I'm wrong here. I also wanted to understand the rationale behind this. Why is it that you see that SBI is a more meatier investment right now as opposed to ICICI Bank?
Actually, we have a significant holding in both the banks, the SBI and the ICICI Bank. It is just that at times in some funds we breach the regulatory norm, which is the 10% norm, and we have to top slice a bit. So that is the reason why it looks that way. But otherwise, we are significantly overweight across the banking sector, and within the banking sector, we have prioritized the private sector banks. In some schemes, we do have exposure to State Bank of India as well. So I think that's how we are positioned right now. We have overweight stance, and what I mentioned to you about the banking sector, we are of a firm believer that as the economy expands, the banking sector is well poised, both from the growth perspective, from the asset quality perspective, from valuation perspective. I think the valuations are pretty reasonable. When I look at some of these banks, on a price to book value basis, they have still not reached their pre-COVID peak, and we have seen performance improving in the last since the COVID has taken place. So I would say that we have these instances in the banking sector where performance is improving, but the valuations have still to catch up. And there are other sectors where the valuations have gone much beyond their historical peaks and averages, and which is where I think it makes sense to be overweight in the banking sector.
Sure, get that point. Vinith, also wanted to understand your outlook on IT. You just talked about staying away from highly leveraged companies. You talked about as to how the inflationary impact would definitely bring on a margin squeeze further. And we've seen that pretty much across the board from India Inc.'s commentary on the sidelines of Q3. But is IT also a sector you want to ease off at least a little bit right now, if not completely avoid or exit? Purely because, these stocks have run up as well a whole lot.
So IT, I generally tend to have a bit of a positive view overall because of a simple fact that the visibility of growth there tends to be better versus some of the other segments. While the IT sector is also facing the supply side issue, and they are seeing wage increases, which is impacting their margins, but their profitability or the margins impact is not as high as what we witness in some of the other sectors. So from the point of view of the deal wins, the deal pipelines, the corporates wanting to adopt to this whole digitization and cloud theme, I feel the opportunity is big. The growth uptick has just about started last year. And through the interactions with the management, through the interactions with the various analysts who are actually doing very on the ground job, it seems that this type of a growth should last for another 3 or 4 years. and which means that the IT sector overall, at least from the growth perspective, should not disappoint going forward. Now, what one needs to sort of factor is the valuations, at what valuation one would be comfortable with. So I would say from the large cap pack, the valuations are pretty reasonable despite the rise. The mid caps are slightly on the higher side. One needs to be slightly more cautious when one is taking exposure at those price points. But we are seeing moderation more on the mid cap IT side. At certain point, probably even the mid cap IT may become reasonable in valuation. So I would sort of try to skew my thoughts more positively on the IT sector. Large caps are pretty okay. It's the mid cap where one may want to time it and may want to look at a certain price point. So that's how I would like to give my views on the IT sector.
Vinit, 7% US inflation, 6% Indian inflation, Mahንगाई is something which will impact the entire electorate. And we know that reforms don't win elections. It is inflation which forces people to lose elections. So from a market standpoint, since it's all about outthinking what people are thinking right now, does it make sense to make a portfolio which will benefit if inflation comes down? Go back to Asian Paints, consumer durable, consumer staples.
So as I was talking about the growth factor as well, I think what beats most factors is the growth. Now, generally, it is also true that the growth also brings with it some bit of inflation, some bit of higher interest rate. It cannot happen in isolation. If there is going to be growth, you will have some of these elements, as byproduct of this growth. Now, having said that, which also makes me believe that certain amount of inflation, certain amount of higher interest rate is okay till the time it is not becoming hyper in nature. So I would say the initial phase of this period where it is backed by decent growth, I would not be worried. But right now, at the moment, the segments which you spoke about are also seeing some bit of growth moderation. So clearly, on the signs of this growth coming back, one would be able to take a better judgment and evaluate these companies from the portfolio sizing perspective. But these are, I would say, these are all very strong blue chip leading companies. The next 5-10 years, probably they will not see bigger disruption. They will keep gaining market share. So we continue to hold a good view on these companies. Just that at what point one needs to size up is something which we keep thinking about.
At what point in time, Vinit, crude will start hurting earnings, economy, macro? As of now, markets are saying, look, it's geopolitical, it is excess liquidity which is causing speculation in the crude, but India is still a energy importer. EVs will come, but Delhi abhi dur hai. At what point in time you would say that now at these levels, macro and crude is a challenge, and we could be in a repeat of what we saw, let's say in 2014 and 15, where macro was bad and micro was good?
Actually, to think about it, Nikunj, crude above $90 anyways is not a positive factor for us. And we are seeing that in terms of the retail fuel prices, which are exorbitant. I mean, to think of prices above 100 rupees is something which we might not have thought about. But anyways, I think, so that is something which is negative. But what has probably not sort of impacted as much this higher crude prices, because I mean, what has been offsetting right now has been the higher exports income which we are earning through the software business. What is also not hurting so much is that all parts of the economy have not opened up fully. So once we have this whole economy guzzling and the certain amount at certain level, I think the kind of requirement of energy will also go up, and that's going to sort of hurt the overall economy as such. And this will only fuel the inflationary expectation if we are staying above this $90. So I would say that these are the levels which are not uh, positive as far as our macroeconomic picture is concerned. But there are some offsetting factors which I mentioned, which is right now not, letting it go out of control in a way.
Final question, Vineet. There are a lot of parallels with a lot of brokerages are drawing that the current turn in the economy, the current turn of liquidity, the current macro environment is quite similar to, let's say, what we saw between 2014 and 15 or 15 or 16, depending on the timeline you want to track. And when that happened, the market got polarized. 20% of the market only moved higher, 80% of the market did nothing. Mid and small cap stocks went through 2-3 years of a painful grind. If the settings are similar, which is liquidity withdrawal, interest rates moving higher, macros deteriorating, could we be in a repeat of that ugly underperforming cycle for mid and small cap stocks?
See, it has to be monitored on a 6 monthly basis. We'll have to keep looking at, as I said, the factors for growth. If that is something which doesn't push these factors, some of what I spoke about, if they are not coming together and pushing the growth forward, then I think we are definitely going to go through that grind, because anyways the other macroeconomic factors are all going to become headwinds, which were tailwinds till last year. So I would say that with the cautious stance is something which one needs to keep in mind. We have gone a bit, slightly more, I can say, frenzied in the last 1.5 year, given what was happening. The macro picture was supportive, but the liquidity was also ample. So people have just gone gaga, and that there's only one way to make money. So I think all those things are reversing right now. And beyond these factors, what actually can accentuate this whole process is the velocity of money. So the velocity of money reversing also will have the similar effect. So it can take the markets, while it took the markets on the upside way higher than the reasonable levels, on the downside as well, these things are possible. So with the markets, I think all things are possible. One can't rule out any of this risk. But so I think extreme caution is something which one needs to keep in mind, and keep monitoring the thesis every 6 months is what I would say, to have a check on whether we have a 1 year of grind, 2 year of grind, or it will be a 6 month grind. So I think all of these things pretty fluid is what I can say.
Okay, we're going to leave it at that. Vinny, thanks so much for joining us live today on the market.